A huge amount has changed over the last little while. So obviously we've had the credit crunch. We've seen the profile of people in debt change quite significantly. So whereas it used to be people coming to us saying that they had taken out some credit and now they were struggling to pay it back, now it's much more about people saying we simply cannot manage. Our income is flat, our expenditure is rising, and we're struggling to meet the gap. So that's been a big change. We've also got a big change, haven't we, in patterns of work. So much more low paid, insecure, 0 hours contracts type work. And of course we're looking at the prospect of interest rate rises in the next little while. All those things together are a heady mix, and we need to make sure that people have the products and services they need to negotiate that difficult landscape.
Well, we estimate there are about 3 million households at the moment who are in severe crisis point debt. But beyond that, there's a trail. Think of there being a slope. At the top end, there's about 20 million who are juggling their finances to try and make ends meet. Then you've got 15 million who are showing at least one sign of financial distress, getting behind on or getting making minimum payments, or getting hit with charges, or using credit to pay for essentials, those kind of things. 6 million using credit regularly just to get through to payday, and 3 million regularly using credit just to pay off other credit. So there's a big conveyor belt going on at the moment. People falling off the bottom in severe debt, but lots of other people who are maybe sliding down that slope. Now, traditionally in sort of debt, policy tends to look at the people who just fall off the bottom. So we have things like bankruptcy, things that where people are, their debt problems have become intractable, and that's where the help has been. What policymakers need to start doing is focusing much more up the slope. By the time people have got to that point of crisis debt, we know that 78% of them will be so stressed that they won't be sleeping properly. 2% will tell us that they've given their job up or had to give their job up because they were so ill because of the stress of debt. 7% of them, their relationships would have broken down. Children in households that are indebted say they're twice as likely to be bullied than children in non-indebted households. So in that process, as people are sliding down that slope, the pressure and the detriment on them is really building. So the real challenge is how do we get to people earlier and stop that before it starts.
People in the UK spend a lot of their income on their mortgages, on housing wealth, and it's very profitable in many ways when house prices go up, but people have to live in that home and can't necessarily access that money when they need it. So if they spend so much of their income on housing, then they're not going to be putting money aside for saving for more short term. So it can be a problem. Some people do access their housing wealth through mortgage reborrowing and so on, but again that increases their level of debt and can be difficult if they lose jobs or their income goes down, and then they might find themselves in arrears, and that's a really big problem if it's your primary residence that you're having debt on. So people need a combination of short-term savings, obviously housing savings, housing wealth, and pensions in the long run too.
Well, I think there is a very big issue around many people who are financially excluded actually having insufficient income. So, we're very interested in approaches that can level, and things like the living wage have obviously been very, very key in this. I think there's a way in which the mainstream have pulled back, so traditional bank and other mainstream sources of finance are definitely less available. There's been the rapid growth of an alternative industry, some of which, as with CDFIs, is, if you like, non-profit and ethical, other elements of which are high profit. I think the big challenge for us as we see financial inclusion, the barriers are really about the unequal flow of capital. It is a higher risk market. Many of those that are financially excluded will have risk profiles that won't fit the mainstream. So what do? We need to create stronger partnerships with those that better understand higher risk profiles and can make those financial products available, but they cannot do it without access to funds. So we're very keen to see much closer partnerships with banks, and indeed roles in which both the regulator and government can play in enabling the capitalisation of what's effectively the locally based side of the financial services industry.
Well, I think we always want to make sure that we can offer credit and indeed payment facilities to as many customers as is sensible to do, namely those who can afford to do it. Really the best strategy on the credit side is to actually enable people to start with a low limit, and there are a number of products on the market like that, and then grow a little bit so that they have a slightly higher limit, and that also helps them to establish a credit details, a credit file, which helps them with their borrowing and their finances more generally. But also we do represent debit issuers, and the people who issue the debit cards obviously enable payments and e-commerce, and enabling people to pay for things more cheaply, often online, is a very good way of helping people manage their finances better.
On the panel we have quite a strong view that actually the way to address this is from a consumer needs and behaviour perspective rather than from a product perspective. People use financial products in different ways for different reasons, and it's that combination of people's behaviour and different product features that can cause problems. So I think you have to be able to look at the product offering in the context of what people need to use it for and how their behaviour is likely to change while they're using it. So starting off with what consumers need, and looking then at what products are available and how might they need to be changed to be more inclusive and to be more likely to deliver meaningful benefits for people.
Financial inclusion is very important for the insurance industry. We think that as guardians of risk for society, we have a really important role to play in making sure that all people, whether they're deemed to be high risk or low risk, whether they live in London, whether they live up in the north of England, whether they're high income, whether they're low income, are able to access the products which allow them to manage their risk effectively. There's an awful lot of work that's been done by the insurance industry in recent years to try and make sure that we are as inclusive as possible. Just in the last year, we've signed an age agreement, which has meant that insurers will now signpost older customers to places where they can get travel insurance if the insurer can't offer them cover. We've seen significant changes take place in the pensions environment, which will make sure that through auto-enrolment and through the establishment of Nest, all people who are in a workplace can access a pension and start saving for their retirement, which is important. And overall, we're continuing to make progress to make sure that people can protect themselves against the shocks and the stresses which can disrupt their daily lives.